Hey, good afternoon, everyone. Marty Mazzori here. It is the 7th of March, 2025. This is your end of week report or update. Folks, this one for sure is going to be brief relative to what you're used to because I just really feel compelled to just cut right to the chase and talk about the equity market and talk about the immediate term setup for asset prices right now based on everything that's going on and things we should be thinking about going forward. But just briefly on the economy, the jobs number came out today. It was okay. Doesn't suggest that the Fed should be freaking out about recession. A revision lower for last month's, but it came in at, I think, 151,000 jobs, which was close enough to the estimate. The household survey was like 500,000 jobs lost, but last month it was like 2 million gained. That one is incredibly noisy, but that is where they get the unemployment rate, which kicked up to 4.1%, and the U6 unemployment rate, which includes discouraged workers, people working part-time for economic reasons and so on, that actually ticked up from 7.5% to 8%. And average work week stayed very, very low. It's at a multi-year low in terms of number of hours worked. So again, nothing really robust there, but nothing that says, recession is looming. Our own economic index is at a -4, which slightly favors recession risk going forward over continued expansion risk. The ISM PMI, Purchasing Managers Index for the manufacturing space, came out Monday. It was weaker, meaning a slower rate of expected growth, still expansion, but just slightly. Services came in better than expected. So still lots of mixed signals out there. I've mentioned here lately that the Eurozone is looking a bit more positive. There's been lots of talk here of late about very different fiscal measures than we've become accustomed to over decades and decades in Europe. They're going to spend money on defense. The new German leadership is going to unleash the German budget, which is something that previously was unheard of, and really begin to spend, and lots of talk of just kind of redesigning the whole zeitgeist in Europe and how they approach their markets, how they approach their economy, how they approach regulation and so forth, and essentially start spending money and running bigger deficits. So I want to just kind of highlight, with that in mind, something that Bob Elliott, who's a analyst whom I respect, don't always agree with, but I absolutely respect his opinion. And he gave a lot of information that leads to this particular statement, but this is the one I wanted to make. The world is shifting relative to the last 10 years of U.S. exceptionalism. U.S. is cutting back on spending, or at least threatening to, and increasing isolationist economic and immigration policies. We know that for sure. Much of the rest of the world is picking up efforts to do just the opposite. While there's been tactical shifts in markets in response to this news, as I've mentioned of late, and clients, as you've noticed, we've actually had a pretty good year so far this year, with the U.S. stock market down close to 3% on the year. That's because of this tactical shift to other markets that we happen to be in. I hold no delusions that this is going to be easy or this nice divergence will, be as nice going forward. I do see risk in global equities as well, and we're making some adjustments to accommodate for that risk. But nevertheless, and I've said this for a couple of years now, global markets remain wildly offside long, meaning exposed to the U.S., even over just the last 5 years. Long-term divergences in policy stances like these risk being the spark, creating a secular reversal in capital allocation. Even before this recent apparent change in how the Eurozone operates, we've been talking about the likelihood of that kind of rotation and preparing portfolios to take advantage of that. So we'll see if indeed that has begun, if it's not just more of a response or knee-jerk reaction to what's been promised from the new administration. Time will tell, but we do know, as I've illustrated even this last week, valuations are extremely offside in terms of the U.S., and I referenced Europe earlier, but it's largely the case with the rest of the world as well. So that suggests that there's lots of opportunity out there, but it may be in places that the typical U.S. investor who's been doing well just in U.S. tech stocks, for example, is very unfamiliar with and probably has a tough time believing at this point. So We'll see how that plays out. There was quite a bit of data this week, some of it good, some of it bad, earnings reports, some good, some bad. I'm not really feeling compelled to get deep into those weeds. It's just kind of feeling redundant week after week. I'm kind of tired of saying it's a very mixed picture out there. But, folks, it's a very mixed picture out there. Notice right here, I had this up. This is an article this morning from Bloomberg, and it talks about something that I think got under the market skin earlier today. It's actually U.S. equity market actually up a little bit right now, but it was down noticeably. Scott Bessent, the Treasury Secretary, said this: the market and the economy have just become hooked, and we've become addicted to this government spending. There's going to be a detox period, suggesting that there's going to be some pain. The president himself, who is not typically, at least in his first term, was not one to talk down the markets. He went so far as to say there would be a little disturbance in the economy, and he insists that he's not even looking at the stock market as he makes policy. Now, I said in a recent post that there is indeed a pain point. Didn't look like we've gotten there just yet, but I know midweek it looked like maybe we had. So we shall see. Clearly, there does seem to be an appetite for some pain in the equity markets. Now, I think the equity markets are due for some clearing anyway. And as you know, I've felt that way for quite some time. The technicals are pointing to that. We've had a pretty good decline. It's been a double-digit decline in the NASDAQ, like an 8% or so decline in the S&P. And remember, right before that decline, I was showing you a very bearish short-term pattern on the weekly charts that I showed you how it's played out every single time to, at a minimum, high single-digit, low double-digit correction, and that's exactly what we've had so far. The U.S. market right now is oversold on a near-term basis, so it's due for a pop. Right now, as we speak, it seems to be getting a pop today, but the volatility intraday has been extreme. Up, down, and we'll see how it ends the week. Right now, it's about a half hour before the close. Okay, so to the technicals. Folks, here's the S&P 500, right? Here's right where we had that weekly candle. This is a daily chart that said, look out below. And here we've had that roughly 8% decline. Remember, I said here the other day that I think it was this day right here or this one, that I said that it did not surprise me in the least that the market kind of pogo sticked right off of that 200-day moving average. And I showed you, 5 years of history on that. Well, here we are today, doing it again, but not breaking it. And if you'll recall, I showed you patterns where sometimes it takes months to really break through that 200-day moving average if it's going to happen. If we do break that, there really is nothing stopping in terms of resistance down to about 5,500 on the S&P, which would be another chunk that people would notice. So there's levels of step down here if we do have a good, decent double-digit correction or bear market. There's very little in the momentum indicators that is encouraging, except here on the RSI. This would be the beginning of a bullish divergence, and we're really flirting with pretty oversold territory here. So it makes sense to me that the market would bounce just on technical factors alone. As for the NASDAQ 100 index, or the ETF that tracks it, it has lost its 200-day moving average. Remember, I said if we lose that, with some momentum, what looks like it has, expect it to come back and bounce off of that as resistance. And I was also suggesting if we could get a big bounce, then resistance would be the green line right up here, the 50-day moving average. So if we don't come bounding out of this today, and this looks like it's trying to get back above that, or in the next few days, then this is going to be overhead resistance. And then here on the NASDAQ, it's a fair piece lower that folks will feel if indeed these technical patterns play out, which right now you'd suspect they would. But, a change of heart from the administration on tariffs could be the catalyst to have this thing go back up and even test new all-time highs. This is the kind of volatile market, the kind of vibrations that I've talked about that tends to shake things loose, but it's volatility in both directions. And you can see we'll have extreme moves, even intraday. That's going to be, I think, the state of the market for some time going forward. As for the dollar, Interesting that we're talking about all these tariffs. It's supposed to be bullish for the dollar. It continues to plummet. Why? Because the fear in the market is that it's going to bring on a recession, right? And it's going to bring lower interest rates, which the dollar at these levels is bearish for the dollar. Now, some people would say, wait a minute, in a recession, isn't there this big flight to quality? And the dollar does really well. Yeah, but this is, we haven't seen this kind of recession coming from yields of these levels, in a very, very long time. So while I do expect that there may be a panic place where the world comes rushing to buy treasuries, and we've seen that. I mean, treasury yields are down. I'm going to show you that in a second, but not to the extent that's a real boost for the dollar. I think there is buying of treasuries, but I think this reflects a rotation out of U.S. assets, U.S. stocks in particular, into other places. The European market is up a bunch this year, while the U.S. market is negative. So a rotation among assets, growth assets or risk assets, can do a real number on a currency. So this whole, belief that, when it's risk off, it's good for the dollar. Well, not necessarily if there's rotation to markets denominated in other currencies. And I think that's what's going on, at least, the last several days. As you can see, the dollar kind of plummet here. As for yields, they have spiked back up. I think I was showing you on the technicals right here, at least, that it looked like that would happen, but then that continued to break down. Notice I've drawn a flag pattern here. If that plays out, that means that the economic data that's going to come out or fears over economic growth going forward are going to be heightened. And I mean, this suggests that we could actually get the 10-year down there below 4%, which would be remarkable relative to what we've seen the last 6 months or so. Don't know that that's how it's going to play out, but there's a little more room for this flag here to continue higher. And then we'd be looking for it to break down if this flag pattern works. And I've shown you, flag patterns are fairly reliable patterns, but I've also shown you lots that have failed over the years. So now this all depends on, commentary and economic data as it comes out going forward. And then gold, which we continue to look at, is holding up nicely. Again, the uncertainty is helping gold. Technicals still say that gold is kind of in a weak spot right here. I still think we need to hedge our not small gold position going forward. So folks, I promised that would be a quick one, and it is, and still have quite a bit of my weekly macro work to do today and over the weekend. And so if I think there's anything else that I want to add that would be of interest to you, I will certainly do it. If not, I'll talk to you again middle part of next week. Thank you as always for watching and listening. Take care. Bye-bye.